Good morning. I hope you had a lovely, restful, long weekend. The year is flying by. First quarter is done, and it was a pretty impressive first quarter from a markets perspective. I'll talk to you through that in terms of March returns and the first quarter returns shortly. But firstly, I'm very excited to have Anrich, our head of fixed income, to join me today. And he's going to be explaining our enhanced income fund in more detail and giving you some explanations of what side pockets are and whether they are a good thing or a bad thing. We remain overweight equities, which has worked very well for the funds. But warning signs are starting to flash, and we're starting to head into that seasonally lower equity return, sell in May, go away. We all know that the adage, not something that we use to make investment decisions on, but definitely something to keep in the back of your mind. So it might be soon time to look for something a bit more protective, a bit more defensive, and our enhanced income fund with an 11% current yield is quite an incredible fund. So I look forward to Anrich telling us all about that later on. But first, let's look at the month in March in terms of markets. As I said, the first quarter was incredible. Global stock markets recorded their best first quarter performance in 5 years. That is quite something for markets that were already stretched. And people are concerned about a recession in the US. The best first quarter performance in 5 years is incredible. And as I said, that's worked very well for our funds. And the markets have rallied on the soft economic landing scenario in the US, which is now consensus. At the end of last year, people were still concerned about a recession, but now the consensus is a soft landing in the US. And of course, enthusiasm about artificial intelligence has helped drive markets as well this year. So quite an incredible first quarter. And that's worked out very nicely for the funds. Looking specifically at March, you can see that the big outstanding performance was gold. Gold returning 6.7% in rands for the month of March. A phenomenal return from gold. As you all know, I'm not a gold bug. I certainly understand that gold is running hard, and I know why it is running hard. So the reason it is running is because it's central banks, emerging market central banks, India, China, Middle East, are all buying gold to diversify away from dollar assets to avoid having their assets frozen if they do anything naughty. But that demand could disappear at any time. If you look at the fundamentals of gold relative to the cost of mining gold or relative to real yields on US bonds, because it is a defensive asset class like US bonds, then gold is looking incredibly expensive. And I know some of you are very concerned about inflation in the US and the fact that the US is printing money and that's eroding the dollar. Yes, to some extent, that is the case, but the dollar is still the reserve currency of the world, and it's going to take a long time before the dollar is undermined and alternatives suddenly replace it. So for the moment, I think on an absolute basis, gold is looking expensive, but it can carry on running. So for those of you who think central banks in emerging markets will continue to buy gold, well then gold is something that you can possibly add to your portfolios. Just make sure you get out before the central banks start to sell. It's you've got to buy and you have to sell if you want to make money. Then looking at the negative returns for the month, you can see the FANG, first negative return in quite some time, and that was mostly on the back of Apple. Apple had a lot of negative news during the month of March. Firstly, some antitrust issues that are being leveled against Apple. Secondly, Chinese sales down significantly on the iPhone within China. And then also the fact that many investors are seeing that Apple is behind the curve on AI relative to the other big FANG companies. And so Apple having a bit of a weak month during the month of March and FANG down or pretty much flat for the month. And then South African bonds down 2% for the month. And that was partly because of global bonds, which are also down, but mostly on SA-specific issues. Normally, when the rand strengthens, and you can see there the rand was nearly 2% stronger during the month. Normally, when the rand strengthens, SA bonds do quite well because it lowers the outlook for inflation in South Africa, as a lot of our goods are imported. And but despite that, SA bonds still down for the month on SA-specific issues, in particular the elections that are now only 2 months away. And I'll be talking a lot about elections soon today. So that was the returns for the month of March. The fund performance looking quite similar. If you look at 1 month performance for the month of March, the very strong resource rally, resources up nearly 15% for the month on the back of some good news out of China. That drove emerging markets. So you can see there the Sygnia Itrix MSCI Emerging Markets 50 ETF up nearly 4%. Close behind at also 3.9% was the top 40 index, the South African top 40 index. And in third place, and a first entry since its launch, was the Sygnia Transnational Equities Fund. Now, that's a very, very exciting fund. So in November last year, we converted our SWIX unit trust, it was a passive SWIX unit trust, into an active transnational equity unit trust. Since then, in the 4 months that it's been transformed, the fund has outperformed by 3.8% relative to the old index. That's nearly 1% a month active return so far in that fund. And how is that being achieved? Well, the fund invests in JSE listed companies that have predominantly offshore revenues. So it looks at stocks that are listed on the JSE and looks at ones that sell to global clients, because global clients are growing faster in South Africa. Global clients have more money than South Africans, and it's a good way to diversify against the slow growth that we are seeing in South Africa. And certainly returns over the last 5 years have been about 5% ahead of the SWIX per year, and last 4 months starting off even stronger than that, 4% ahead of the SWIX over 4 months. Now, more importantly, even though it's an active fund, the fees were unchanged. So the Class A is the same fee as the SWIX unit trust used to have, a low passive fee. And then even more phenomenal, and this is the same as our Divi fund, there's a Class B, which has zero management fee. Zero management fee. You only pay a performance fee if the fund beats its benchmark. That's phenomenal. So you're getting not only some of the best returns on the market, and you're getting exposure to global companies, but you can do so at zero management fee, and you only pay when it outperforms. So definitely something for you to look at. Obviously, it's constrained by the universe of being JSE listed companies. So for those of you with global mandates, going offshore directly makes more sense. But if you have money that's limited to South African equity stocks, where Regulation 28 or your living annuity doesn't allow more offshore, well, it's a phenomenal option B for you to look at. Then looking at the 1 year or 12-month performance, very much the same as it has been. It's all about US exceptionalism. It's all about AI stocks. So it's all about weak rand. You can see the top 4 positions there being all US Sygnia funds: the FANG.AI Equity Fund, the Berkshire Hathaway Fund, S&P 500, MSCI US, which is 70%, that's 100% US, and MSCI Japan sneaking in there into 5th place, as Japan has done quite nicely due to their weak yen, which has supported local growth and their exports. So those are the top performing funds for the month of March. Nice to see a rebound from emerging markets in South Africa. It may last a little bit longer because of the renewed green shoots that we're seeing in terms of manufacturing. Unlikely to be sustained over a long-term period, but hopefully a bit more upside to emerging markets and JSE stocks in the short term as resources and global growth recovers. Okay, so let's start off with the charts of the month. When we started this year and going into the beginning of this year, we were quite concerned about volatility caused by politics. Well, nearly half the world's population in more than 40 countries are voting this year. And 2 of the big ones, for us at least, are the US elections in November and the South African elections in May, 29th of May and 5th of November, respectively. So we wanted to look at how those elections impact markets, and particularly how they impact currencies, because the rand is something that drives everything in our markets. It's incredibly volatile and has an impact on all our decisions. Now, the rand dollar is by definition driven by the rand, and it's also driven by the dollar. So it's equally important to look at the dollar and the rand. And of course, we're a small open economy that exports commodities and imports commodities. So we are definitely driven by global forces to a large extent. So the chart on the right is from Investec, and they've shown the rand over the last 14 years and they're broken down into global components and South African specific components. So you can see there from 2010 to 2015, the Rand was ahead of the global components. What we were doing was actually good, and it was helping the Rand strengthen more than the global drivers would suggest. But then over the last 9 years, the reverse has happened. We've seen Nenegate, COVID, Whigby exclusion, the Moody's downgrade to junk, the Lady R debacle, load shedding have all led to a weaker Rand. And that's, in fact, right now, they're saying that fair value for the Rand based on global drivers is 18. And right now at 19 to the Rand, there's a 1 Rand risk premium driven into that price because of the elections that are looming. So we face South Africa-specific risks to our currency. We also face dollar-specific risks to our currency, and that's very much dependent on US elections as well. So let's start off with the US. So the dollar is the reserve currency of the world. It drives everything. 80 to 90% of global trade is done in dollars. So the cost of the dollar interest rates impact emerging markets, impact global trade significantly. It's really the key starting point to any analysis is the dollar and the cost of the dollar. Given that, so what drives the dollar? Well, most importantly, in the short term is interest rate differentials. So the US is currently sitting at a short-term interest rate of over 5% compared to what's happening in Europe and Japan, are all slightly lower. But more importantly, what is the outlook for that? An outlook for interest rate differentials is actually that the US is going to cut interest rates faster than the rest of the world, mostly because they're starting at a higher point. So that interest rate differential is going to narrow in the favor of the euro and in favor of the yen and not and against the dollar. So based purely on that starting point, the dollar should weaken. However, it's not just interest rate differentials. The second big driver is growth differentials. When the US is growing stronger than the rest of the world, well, it can actually afford high interest rates, and that growth differential helps the dollar stay stronger. Right now, the US, and certainly over the last 18 months, the US has been growing much faster than the rest of the world. We've seen US exceptionalism, FANG stocks, high interest rates, high growth, low unemployment. That's kept the US strong. It's kept the dollar strong. So if we start to see the rest of the world start to pick up into this growth, and we are now seeing it, we're seeing some green shoots coming through, well, then the dollar could also weaken. But whether it does so in a sustained manner is something that is not as clear. But in the short term, at least, interest rate differentials could drive the dollar weaker. Growth differentials could drive the dollar weaker. So both of those would be a weaker dollar. And then we have the risk factor. So the dollar is not only the reserve currency of the world, but it's seen as the global safe haven. So whenever anything goes wrong, people rush off and buy the dollar. In fact, even when we had the US government shutdown last year because the US wasn't doing the right things, what happened? The dollar strengthened. And during that time, the US credit was downgraded. And what happened? The dollar strengthened. So the US also benefits from a risk-off scenario. The dollar will strengthen in a risk-off and weaken in a risk-on. So those are your 3 big drivers: interest rate differentials, growth differentials, and risk-off, risk-on. So how does that impact elections? Well, if Trump wins, Trump's very much focused on the US at the exclusion of the rest of the world. In fact, he doesn't even see the rest of the world. It's all about the US. He doesn't play nicely with anybody else. And if Trump does win, certainly US growth relative to the rest of the world will probably do better, whether it's because of tariffs or trade embargoes or just focusing more on friendshoring and onshoring, the US will grow faster than the rest of the world, at least in the short term. The second thing is that Trump, again, doesn't play nicely with others, and geopolitical tensions are most likely going to increase if Trump wins, which will mean more of a risk-off scenario, again, positive for the dollar. On the other hand, Biden, he does play nicely with others. He's quite cognizant that the US is just part of the global trade. It's just one cog in the whole world. Even if it was the biggest cog, it's still a part of the world, doesn't live in isolation. And certainly global trade will probably do better. The whole world will grow better, but the US probably won't grow as fast relative to the rest of the world. Also, in the short term, if you look at the antitrust forces that have happened in the US under the current Biden regime compared to previous democratic regimes, it's been far, far less. There have been hardly any antitrust enforcements under the Biden regime. So given that elections are on the way and we're likely to see saber rattling, one of the sabers that Biden is probably going to rattle is the more antitrust enforcements against the FANG stocks. Unlikely to have any impact in the long term, but there will be some short-term noise, and that could see the dollar weaken slightly. So it's going to be very much the dollar can tick higher as Trump moves into #1 place, and the dollar ticks weaker when Biden moves into pole position. Right now, the polls are a dead tie, both at 45% based on this morning's Economist polls. So we'll be watching it very closely. Of course, it has an impact on the rest of the world, and South Africa is an emerging market and very much dependent on rest of world growth, particularly Europe's growth and China's growth. And so if Biden does come into power, well, it's not as good for South Africa, and the rand will probably weaken accordingly. Whereas if Biden stays in power, the rand will have a little bit more support. So a lot of global forces will impact the dollar, which will then impact the rand dollar, and we'll be watching the US elections very, very closely. When it comes to South Africa, well, the polls, I'll show you a chart of the polls later on. It can go, there's some very, very wide dispersions in terms of what the polls are saying. But let's look at three broad scenarios. The first is that the ANC, 5 years ago, the ANC won 57.5%. Let's say the ANC either stays a majority, so 50 to 57.5, or even loses down to 45%, loses majority, but is only required to have a coalition with some of the minority parties. It's basically a status quo. They can make sure those minority parties vote in line with whatever they wanted to do. And so nothing really changes. If that's the case, well, then maybe the rand could strengthen to 18 after elections because the risk premium will move out because of the worst case scenario. So what's the worst case scenario? Well, the worst case scenario is the ANC gets in the low 40s or below 40%, and they're forced to do a coalition with either the EFF and the MK parties. And then we could see some seriously radical economic policies happen in South Africa. And then the rand's likely to rush past 21 to the dollar, probably a lot weaker than that, as people start to seriously worry about what's going to happen in South Africa. On the other hand, if that's probably the low road, on the high road is that the ANC gets between 40 and 45%, and they decide to build a coalition with the multi-party charter or the DA. This would hopefully see some accelerated reforms, and then the rand could actually strengthen down to 17 to the dollar on that hope that things could improve and we could see some accelerated improvement. So we'll be watching the elections very, very, very closely in the US and South Africa, watching the polls as they come out very closely. Until then, people are probably going to err a bit to the cautious side, both globally and locally. Certainly, if the foreigners haven't started to nibble in South Africa, there's still 2 months. They're unlikely to start to nibble until the elections are through and they can make a more decisive decision. No need for them really to take on the risk right now. Yes, South African equities are looking incredibly cheap. I don't think anyone's arguing with that, as are South African bonds, but the catalyst is at least 2 months away based on the elections. Okay, so let's go back to the big driver of the world, which is the US. US dollar, US interest rates. And here we have Fed Chair Jeremy Powell, and he was saying at his semi-annual testimony to the Senate Banking Committee that inflation is not far from where it needs to be for the Fed to start cutting interest rates, which is pretty dovish. In fact, he stole that wording from President Christine Lagarde of the ECB. And not only is it dovish in that he's saying that we could cut rates soon, but it's very important because he's starting to trying to align with interest rate cuts with what's happening with the rest of the world, which again will make sure the dollar doesn't strengthen relative to the euro unnecessarily. So that's important. But equally, or probably even more importantly, we had the March FOMC, and the dot plots were updated, and there were some very, very interesting outcomes. Basically, what the Fed did was they've lowered the bar to cut interest rates. It's a very, very, very important factor. So what they did is they said growth is going to be much stronger than expected, more than 1% stronger than before. But inflation is only going to be, so their core PCE is only going to be 20 basis points higher than previously expected. And despite that, so despite upgrading growth by 1% and despite upgrading inflation by 0.2%, they still kept 3 cuts. Now we had January core PCE was at 2.8%. We had the February core PCE came out on Friday, and that ticked down even lower. And all that is showing is that it's actually going to be quite easy for that number to be achieved. And so the Fed's saying, we don't mind if inflation is not at 2% by the end of the year, we can start cutting interest rates. So that just makes it easier for the Fed to cut rates. And that's why we think our 3 cuts that the Fed is pricing in are going to be achieved, which is probably desperately needed. If you look at what's happening in the US consumer, and if you look at what's happening in the US commercial real estate environment, those interest rates cuts are needed, despite the fact that US growth has been quite resilient. So let's look at the US consumer. As I said last month, they are running out of cash. US unemployment unexpectedly increased to its highest level in 2 years. So that is a concern. But more importantly, we continue to see more weakness in the US consumer. They're running out of cash. Their credit card expenditure is at extreme highs. If you look at the chart on the right, I mean, it's quite a scary chart. The blue line, so this goes back to 1978. The blue line at the bottom is interest payments by US households on non-mortgage debt, so credit card debt, vehicle finance. The purple line at the top is the interest payments on their mortgages. So you can think about yourself, how much you spend on your bond, or how much you did spend on your bond when you had a bond, relative to how much you were spending on your credit card and your car payments each month. And you can see that generally over the last 50 years, people spent about twice as much on their bond as they did on their credit card. And that makes sense. Your bond is backed by an asset, by your house, and that house is going to grow in real terms. So you've borrowed to buy an asset that's growing, and if you sell, you're likely to be able to pay down that debt with an appreciated asset. Whereas your credit card is expenditure. I mean, that's very short term, and it is terrifying to think that the US as a whole is spending as much money paying for their credit cards as they are for their mortgages. Now, a lot of that is also distorted because credit card debt is short-term and short-term rates have risen, and mortgage interest rates are linked to 30-year debt, which hasn't gone as much. So there are some technical factors, but it doesn't matter what those factors are. The bottom line is US consumers are spending as much on their credit cards as they are on their bond, and that's definitely a sign of stress. So we definitely are seeing some amber flashing signals from the US consumer. At the same time, the US property market's also starting to look quite weak. The office vacancy rate is at 20%. It's at the highest level since the data started in 1979. So we're looking at some serious big numbers. The interest payments going back to 1978. Office vacancies at the highest levels since 1979. And we've also seen the share of delinquent loans in commercial real estate CLOs, collateralized loan agreements, which have surged 4-fold in January. So a lot of amber flashing signs in terms of the office sector and commercial real estate in the US, as well as the US consumer. So those which say that the Fed should actually start cutting rates sooner than the 3 cuts that we're expecting in June. And there was then some concern because CPI came out and PPI came out, and both of those were higher than expected. So people were worried about stagflation. Now seeing inflation picking up while growth is slowing. Fortunately, as I said, core PCE was in line with expectations. And we generally think that inflation is actually going to fall a little bit faster than the Fed's expecting. Why? A couple of reasons. Firstly, Chinese export prices are still falling. So the US is importing goods inflation. Goods disinflation, sorry. So that's good for the US. Secondly, the Zillow and new tenant rent indices are suggesting that rent inflation or shelter inflation driven by owner's equivalent rent. It's a very weird concept in the US. So basically, people who own a house and live in their house, they're asked in a survey how much they would rent their house out for, how much they would like to earn from rent if they rent out their house. So it's like, well, of course, I'd like to earn as much as I can. Anyway, that number is still lagging, but it will follow the Zillow rental indice and the new tenant rent indices lower. But more importantly, we're also seeing a huge amount of supply coming on in the US. And that's actually the amount of housing that is coming on, supply that's coming online in the US is nearly double the average of the last 2 decades. So yes, there's been this short-term, again, COVID distortion in terms of demand and supply, but we are seeing now finally some supply coming into the US housing market, which will help housing inflation roll over. And then finally, although jobs have been relatively stable, yes, we saw that we're now unemployment at the highest level in 2 years, but it's only 3.9%. But if you look deeper into that data, the US has lost 2 million full-time jobs, which have been replaced by part-time jobs. And that's, again, a sign of a weakening employment market. So things are definitely looking like they're weakening in the US. We're still on the non-recession outlook. We still believe in a soft landing, and I'll give you all those reasons when it comes to the outlook. But we're definitely on the slowing US camp. Slowing because of the US consumers slowing because of office vacancies, and slowing because inflation is likely to slow as well. And that all feeds into a softer US outlook for this year. So that's the US, okay, but slowing. And then the other big pillar of growth is China. And China not looking as bad as was feared, but still muddling along as the short outlook. So Premier Li announced at the March National People's Congress that China will target economic growth for 2024 at 5%. That's a bold number, 5% growth. It's despite a higher base. I mean, China is the second biggest economy in the world and growing at more than double the expected rate of the US. So in absolute terms, rand terms, dollar terms, yuan terms, that's the biggest growth engine of the world for 2024. But to achieve that 5%, they're definitely going to require a lot of stimulus to get them out of the property slump, stimulus to get them out of the disinflation slump. And Premier Li acknowledged that. He said, "It is not easy for us to realize these targets. We need policy support and joint efforts from all fronts." So that's positive, because he's kind of intimating that a big bazooka stimulus is on the way, but it hasn't happened yet. So where are we? Well, they did broaden the broad budget deficits. The actual budget deficit was quite, the narrow budget deficit was a bit disappointing. But when you look at the broad budget deficit, which is the chart on the right, and that includes in the blue general bonds, in the green local special bonds, and then in yellow the central special bonds, all of that points to a broad budget deficit of nearly 9%, which is higher than 2023. So there are certainly nothing bazooka-like, but it's definitely higher than 2023, and that is likely to boost, based on Standard Chartered estimates, they think the broad budget deficit is likely to boost GDP by 0.6%. Now, 0.6% on a massive base is actually a huge amount in terms of nominal terms. So that is very, very, very positive. Likewise, if we look at economic data that's coming out of China, it's not looking so bad. So manufacturing output and capital investment grew very, very, very nicely. According to China's National Bureau of Statistics, Chinese exports increased 32.6% from a year earlier in the first 2 months of the year. But unfortunately, we've still got the property market, which is dragging the overall China down. And China's real estate sector or property market is likely to experience the 4th year of contraction this year. So we've got a recovery in manufacturing, we've got a recovery in exports, but consumer sentiment is still depressed because of the property market. And it's all about the wealth effect. When people feel wealthy, they spend. And that's one of the reasons why we aren't worrying about a US recession this year, because US consumers are still feeling wealthy. Yes, they've maxed out their credit cards, but why do they max out their credit cards? Because their house prices are higher, because their investments in the stock market, because their pension funds are all much higher. And so they're feeling good, and they're likely to, or they are spending. Chinese consumers are the other hand, not only are they seeing their house prices collapse, but they have until recently seen their equity prices collapse. So we need that sort of recovery. Yes, China is pulling up all the stops in terms of the Chinese equity market, and that is likely to continue to bounce a little further. It's off its lows. In fact, it's off 19% off its lows, but it's still, down 60% from its highs. But we could see that recover further. In fact, last month I said that Alpine Macro have upgraded China to a speculative buy. This month, BCA upgraded China to neutral, not making it overweight, but neutral. And relative to the benchmark, they think that there could be some more upside to China. And that's pretty much our view at the moment. We don't have any China or emerging markets, but I certainly think things are looking a little bit better there. And we have upgraded our probability matrix. So we have our economic scenarios that we use, and we have probability for each of those economic scenarios. We take a blended view when it comes to our asset allocation, and we did increase our probability of rest of world growth increasing this year relative to the US because of some better news coming out of China, but also some green shoots in the rest of the world. And I'll talk to you about that in the outlook. Okay, so China not doing too badly, muddling along and improving slightly. And then we get to South Africa. Okay, so this is the same slide I had last month, and it is still the key focus for us this month in terms of our debt. South Africa's government gross loan debt percentage of GDP is at its highest point since 1947. That's just a scary, scary number. And more importantly, despite that high debt, we did have a pretty decent budget in terms of the outlook. The forecast for our debt was consolidation. Forecast was a reduction in spending, and the forecast was decent. But Professor Haroon did a deep dive into some of these National Treasury assumptions, and he's a little bit concerned about them. So let's have a look at what his big concerns are. There are two big factors. One is that government did not, when it came to assuming the debt to GDP and the budget deficit and when debt is going to consolidate, the government did not budget for an increase in the social relief of distress grant beyond March 2025. And history would suggest that is unlikely to be the case. Secondly, the government did not, they adjusted the public sector wage bill by only 4.5% in the medium-term framework. Now, the largest public sector unions in South Africa have not agreed to that. So if we have a more realistic outlook that the social relief of distress grant is likely to continue past March 2025, and that the public sector wage bill is probably going to come in closer to 7.5%, well, then South Africa's deficit to GDP ratio jumps from 3.3% to 4.6%. That's a huge bounce in those numbers, and would mean that it'd take many more years before our debt starts to consolidate, which is very much negative from a credit perspective, very much negative from a bond market perspective, and negative in terms of foreigners. Now, foreigners already sold South African bonds hugely. They're about half the weight they used to be, and they continue to not want to hold South African bonds ahead of the elections. We are neutral South African bonds because of the decent yield, the R2032 up to 11.5%. I mean, that's a great yield. So we are holding onto those, but we're not overweight the bonds because there is a lot of risk, and we remain underweight South African equities because, well, it's just when you can get 11.5% risk-free, you really have to have some really strong returns from equities to justify moving out of that risk-free asset class. The volatility of equities is generally more than double bonds, so you're going to need a much higher return than 11.5%. And right now, with growth as it is, well, we're not seeing that, and we prefer our transnational fund in terms of our outlook for SA equities, and we are underweight South African equities as a whole from our position. So I mentioned the election risks. We had an update on the polling in the February poll from Brenthurst, which shows the chart on the right. So certainly some big swings. And I don't know if we can trust this data completely. So, I'm certainly not banking on this data, but it is quite scary what they're showing. So the light blue, or the right-hand bar for each area, shows the latest results. ANC predicted to come in at 39%. The multi-party charter at 33, DA up to 27. The new MK party coming into the polls for the first time at 13%. EFF losing a big slug of its share to the MK party, down from 17 to 10%. IFP also losing a big share of the vote from 17 down to 10. Sorry, from 7 down to 2. So overall, some big swings in terms of that outlook. Yeah, I'm not too sure that that's the case. I still think we're going to sit in about mid-40s when it comes to the ANC vote, but we'll see what happens. More polls will be coming out closer to the time, and our markets will certainly be victim to, or held hostage to those polls. So we'll be maintaining our defensive outlook until we have more certainty in the elections on the 29th of May. So underweight South African equities, neutral South African bonds into the elections. So quickly, our outlook before I hand over to Anrich. So we also had some very interesting data points come out this month. As I said, the rest of the world growth is starting to recover, and not only in emerging markets, but also developed markets. Germany, so the chart on the right shows Taiwan's trade figures and the Swedish krona, both of which tend to lead global manufacturing by 5 to 6 months. And those are both suggest that there are green shoots, and the rest of the world, ex-US, is starting to recover, despite China, although China is also recovering slightly as well. And it's not just Taiwan and Sweden and Europe, but growth is actually recovering in Japan. And Japan ended 8 years of negative policy rates, and its first rate hike in 17 years. I mean, that is just phenomenal. Japan's first interest rate hike in 17 years. So that isn't a sign of green shoots. Well, then nothing really is. So we're starting to see growth recover in the rest of the world. Taiwan's trade figures, the Bank of Japan's rate outlook, Swedish krona, all pointing to at least in the short term, growth recovering. And you can see on the right there, the chart. This is Swedish manufacturing PMI, new orders to inventories leading global manufacturing PMI, suggesting the global PMI could tick up quite nicely. It was one of the reasons why China is recovering in terms of the equity index. It's one of the reasons that commodities are recovering and South African resources are recovering, and we are starting to see these green shoots. And it is another reason why the US is unlikely to move into recession, because as the US slows because of the consumer, so US exports and US manufacturing will recover. And S&P 500 has at least a third of their revenues come from offshore companies, and that will be buoyed by the recovery in the rest of the world. Not only that, but the US exceptionalism is helped by its energy independence. And according to the US EIA, the US produced 28% more oil in 2023 than the world's previous top producer, than was Russia, and 33% more than Saudi Arabia. So the US is now not only energy independent, but the largest oil manufacturer in the world. That's quite incredible. The US just continues to surprise to the upside on growth, oil manufacturing, and that's likely to continue. And another reason why we do think that while the US is slowing, we're not going to see a recession. Other reasons, well, we're also seeing a productivity resurgence in the US. We've got, as I said, very strong household balance sheets, which talks to the wealth effect in the US, and monetary policy is already easing. So mortgage rates have dropped from over 8% down to 6.5% because mortgage rates anticipate the Fed rate cuts, and we do think the Fed will cut 3 times this year, which will help the US avoid a recession. Now, it's definitely going to become quite a fine balance, a Goldilocks scenario, which is always hard to assume as a base case. So I think towards the end of this year and beginning of next year, things could look a little bit more dicey. But on a 6-month horizon, things are looking okay, and that is why we are still overweight our position in US equities and overweight equities as a whole. And we do think that despite interest rate differentials, which would mean a weaker dollar. And despite these green shoots in manufacturing, which would mean a weaker dollar, that generally the dollar is not going to weaken too much because of political risk and because of China not having extreme stimulus, which would drive growth, and we think that their growth will be more of a tepid recovery. Yes, not recessionary, but also not going to be very, very strong growth. So that pretty much brings us to the end of the outlook. Before I hand over to Anrich, two announcements. One, our polls will be back in the webinar next month, so it's very exciting. Looking forward to getting your views. I really do appreciate your views, and it's very interesting to see what you are thinking and to help our outlook. And yes, and now it's just to hand over to Anrich, our head of fixed income. As I said, the fixed enhanced income, Sygnia Enhanced Income Fund is looking incredible with its current yield. And as we head into weaker calendar effects of the year in May, maybe it's time to lock in some of these amazing returns we had in the first quarter and bank them into the Enhanced Income Fund. We're not doing that yet in our portfolios, but for those of you with a bit more of a defensive outlook, it's certainly something to at least think about. Okay, over to Anrich.
Thanks, Kyle. Good morning, everyone. So today we're going to take a look at the Sygnia Enhanced Income Fund. First, if we just take a look at our range of fixed income products at Sygnia, so it's across the spectrum from your ultra short, low risk money market fund, which is yielding approximately 9% gross of fees, all the way up to our enhanced all bond fund, which has the same duration risk as the all B, but we add about 40 to 50 bips in additional yield of the index. But of course, today we're talking about the enhanced income unit trust. So we're very proud that it now has a 5-year track record. It sits in the ASISA South African multi-asset income category. So it's quite a diverse category in terms of funds that fall under that label. I would definitely describe our fund as one that's one of the lesser volatile options, just when it comes to lower interest rate risk than some of our peers in the group. If we take a look at some of the stats of the fund, so it's currently giving you a gross yield of just under 11%. And if you compare that to where 3-month JIBAR is at the moment, you're getting a spread of over 250 basis points on the fund. And then throughout, you'll hear me talking about how we focus on keeping interest rate risk and duration risk in the fund low. So we do not ever want to take on too much duration risk. The current weighted average duration of the fund is 0.4 years. Just to put that into context, if you look at the All B, that has a modified duration of about 5.6 years. And then, although we have the option to add term premium in the fund, the current weighted average maturity is around 3.3 years. So quite short dated as well. Then, if we take a look at our approach to managing this fund, I think these two tables explain it quite well. The fund is multi-managed. So on the left-hand side is essentially the credit portion that we manage in-house at Sygnia. So we aim to provide investors with a broad, highly diversified basket of exposure to the liquid part of the credit market. And then on the other hand, we go and search for and analyze managers that we give specialist credit mandates to, and they go and trade in parts of the market that we don't cover. And of course, then they also have the added benefit of not having to worry too much about liquidity, so they're able to harness that liquidity premium as well. And then at product level, we still manage risk, issuer limits, strategic and tactical asset allocation to ensure it's still in line with our house view. If we take a look at the managers currently in the fund and the split, the weightings at the moment, as I mentioned, we manage the liquid portion. It's mostly exposed to banks and blue chip corporate issuers. We have a 7-person credit committee at Sygnia that monitors and implements all credit limits and exposures. And then we also manage those tactical allocations, and that mainly includes to REIT shares as well as to nominal bonds. Then Quanta and Aluwani both have, very good large credit teams in-house. They have the ability to go out and structure deals directly with counterparties. And even though they have this kind of same skill set and approach, the two portfolios do look very different, which helps with diversification in the fund. And then finally, we also have an allocation to the Ashburton High Yield Co-Investment Note. So it's all unlisted exposure, and essentially Ashburton has the ability to co-invest into loans that have been originated by RMB. So both sit in the F&B stable of companies. And then they also have tag-along rights. So if RMB sells, they have the right to sell as well. And then, yeah, at product level, at an investor level, this combination of mandates really gives you incredibly wide exposure to the market. And there's really very, very little overlap amongst these mandates. Then if we take a look at your credit exposure in the fund, so here we have our top 25 exposures. I think it's very important to note that this is on a look-through basis. So we drill through each of the underlying funds, the holdings at the very bottom level, but we also importantly look through structured exposure. So where there's a credit-linked note or any kind of structured note, we are showing you the underlying credit exposure to ensure there's transparency. In total, the fund is exposed to 74 unique counterparties, so incredibly diversified. That's about an average exposure of 1.4% to an issuer. And if you remove the 5 big banks and the government exposure, that average exposure per issuer goes down to 0.8%. But we've shown you the top 25 here. So we have around 34% exposure to banks, just under 16% to the government. So that's almost half of the fund. And the remaining tail of issuers is diversified across several other names. So the point is you really won't ever see one single corporate being 9 or 10% of the fund. We don't want that concentration risk. And we do focus a lot on maximizing diversification inside the fund. Then if we look at positioning since inception, you'll see, obviously, we ramped up the fund at the start, but the allocations have remained incredibly stable, and this counts for the manager allocations as well. The only times there will really be a deviation is where we take a tactical position in either REIT shares or fixed rate bonds. For the REITs, we tend not to go over 3 or 4%, so it's still quite small just because they are quite volatile, and we don't hold any at the moment. And then for fixed rate bonds, we really haven't gone above, say, 7 or 8%. And even then, it's only when there's, an extreme amount of value on offer. And then if we look at performance over the 5-year track record, so I've compared it here towards the benchmark, which is the Steffi index. And then I've also compared it to the average return for the category that it sits in. And you can see we've managed to outperform both quite comfortably over all periods at a lower level of volatility. So that 10.5% return over the last year is for the A class, so that's net of fees. And I've also included the rankings, 9th out of 115 over 1 year, all the way out to since inception, the 5-year or 5-year and 2-month period, where we're 15th out of 81. And then finally, I think this slide summarizes the fund quite well. So this is just your risk return scatter plot for all the funds in the category over the 5 years. And you can see we do focus on maximizing your returns by providing a good yield, but it's all within quite a stringent risk management framework. So if you go back to March 2020, when the market completely sold off with COVID, the average fund return in the category was minus 2.4%. we managed to limit that drawdown to 60 basis points. So it all speaks to keeping that interest rate risk low, keeping duration risk low, and providing good diversification. So that is the end for the fund slides. We had a few questions on side pockets, just given some of the recent market developments. So I've just included some high-level points on what it is, when you use it, what it's used for, and it essentially comes down to a new portfolio that you create by carving out assets from your main fund. It's usually done if a bond went into default or an instrument is experiencing financial distress, and there's either no liquidity to trade that instrument, or it goes unlisted and there's uncertainty on how to value it. So you're just kind of segregating that troubled asset. We've seen this play out with some of the recent defaults, so all the way from African Bank to Sign-Off, Land Bank, and more recently, Bridge Taxi Finance. It's by no means a perfect process, but it has its pros and cons. So the main advantage is you are protecting new investors coming into the fund so that they don't have exposure to these troubled assets when they make a new investment. But also, if a recovery does play out, it's only the existing investors who would benefit from that recovery, which is also fair. It, of course, has a few drawbacks as well. It's usually quite admin intensive, and there will probably be some additional costs in administering that portfolio. And an additional drawback is, even if you side pocket to protect new investors, the whole thing becomes a bit more complicated if it's held in a multi-managed fund or fund of fund. We've also seen in the media some commentary around the biggest drawback being that you're sanitizing the return history for your main fund. So you're taking this distressed asset and removing it from your return track record. But the FSCA, after the African Bank default, did put out a guidance note on how to report on these types of situations. They deferred to GIPS, the Global Investment Performance Standards, and the recommendation is that you create a composite, which includes the returns, the weighted returns for the main fund and the side pocket, so to ensure that investors get accurate reporting. And then there are very few alternatives, but what we've also seen happen is that if there is a default, a fund manager could choose to rather just write that asset down to zero. So your loss over the short term will be much bigger in all likelihood. But it kind of solves the issue of investors coming in and out afterwards, then not being exposed to that because it's worth nothing. I guess the other side of that is if there is a recovery, a new investor could come in and participate in that recovery. So yeah, I hope that added a bit more detail to how these side pockets work. And that's it from my side. If anyone has any questions on the fund, please do reach out. Yeah, thank you very much.
Thanks, Anrich. A great summary of the fund. Okay, moving on to Q&A. Some questions have come through. Chris asks, I'd like to know which organization monitors whether a fund complies to the 45% offshore. So Chris, the 45% offshore is a Regulation 28 limit. So the Prudential Authority is the one that monitors that. We do have to submit those numbers to the PA to make sure that, and the SARB to make sure that the funds are under the 45% limit. And that applies to your investment, your retirement investment as a whole. So whether it's an RA or a preservation fund or a retirement fund, you need to stay under that 45% as a whole. Megan asks, has the asset allocation changed in the Worldwide Flexible Fund? Megan, the Worldwide Flexible Fund can have 100% offshore, so it's not constrained by any limits. But the rough benchmark for that fund is 50% SA, 50% global. So it's different to our International Flexible Fund, which is 100% global, and our International Equity Fund of Fund, which is 100% global. Worldwide Flex is about half as a starting point. Johan asks a great question on platinum. I do love platinum very much. He says, what is your medium to long-term outlook on platinum? So in the short term, platinum's looking pretty horrendous. There's a lot of supply and not much demand, as the EV market, electric vehicle market, certainly has beaten expectations, and they've replaced the ICE vehicles faster than expected, and so the demand for platinum has been lower than expected, and so platinum prices have been pretty low. Longer term, I still think there's upside to platinum, but that is long term. I do think that hydrogen fuel cells are going to be important for at least heavy vehicles, whether it's trucks or buses or trains. That is a strong use for hydrogen in the future. Plus, to me, I always like to compare platinum to gold. There's more uses for platinum than there is for gold from an industrial perspective. There's less platinum on Earth than there is gold. So you've got lower supply and high demand, a more rare metal, it's a stronger metal, less soft than gold. So to me, longer term, I would think that platinum is a better investment than gold, but gold is seen as a unit of exchange or a currency, and platinum is not. But then for a long time, silver was seen as a unit of exchange as well. So, you can also look at silver relative to gold as well as platinum relative to gold. I do think that platinum is cheap, but in the short term, the catalysts are lacking. It is currently oversupplied relative to demand because of the strong EV growth relative to traditional vehicles. Anonymous says that it's ludicrous that the public sector wages go up at 7.5%. I would hope that the government wage bill doesn't go up by 7.5%, but more ludicrous things have happened in the past in South Africa. So, but I do think 4.5% is being very, very, very conservative for public sector wages to go up less than inflation. It's going to be very tough to achieve. Maybe somewhere in between. Either way, we're not going to meet the budget deficit estimates that were put in place. Albert says, Carl, you mentioned that bonds at 11.5% is a risk-free asset class. Are they truly risk-free? It's a good question. They can't default. They're unlikely to default because the government can just print more money. There's no shortage of rands. There's no reason why South African bonds could ever default. However, there is definitely volatility in bonds. And as our budget deficits look worse than expected, and so South Africa has to print more money and more bonds, which is inflationary, so that the government bond yield do rise and the curve does steepen. And so there is certainly some risk, and that's why we are not overweight government bonds, even though 11.5% is a juicy yield. It could and has gone higher in the past as bad news comes out, or as foreigners sell, supply and demand. So it is risk-free from a default perspective and a growth perspective. It's not risk-free from a volatility perspective, and so that's one of the reasons why we are underweight. Equally weight South African bonds. Wayne says, with our debt to GDP sliding further, revenue from high net worth individuals declining and government grants increasing, where do you see the solution? Well, I suppose that's, Wayne, that is the point that Professor Haroon is making, that our budget deficits are going to struggle to come into target. Our debt is going to struggle to consolidate with us spending more money than we have. I see there was an update in the news this morning about immigration. We've lost over 1 million people to immigration over the last 20 years. There are only about 4 million taxpayers. So when you're losing 20% or 25% of your tax base, that's a lot, even if it is only 1% a year. So things are looking tough in South Africa. What is the solution? Well, the solution, hopefully, is public-private partnerships, like we have seen with the solar panels and renewable energy, that the private sector is allowed to help government. The problem is, until recently, the private sector wasn't allowed to help Eskom. We still haven't seen the private sector being allowed to help Transnet. Some early signs, possibly, private sector can, but the big government doesn't have any money. Governments run out of money, and so we're seeing the selling of the family jewels, and hence the fact that our currency reserves were used to pay down some debt. And in the short term, we need the government to allow the private sector to help with reforms. So that's going to be very much linked to the election outcome, and we'll see what happens. But if the private sector is allowed to help, then there's some decent upside to our worst case scenario. Similar question on South African assets. The Bank of America Fund Manager survey said that 2/3 of South African managers viewed both local bonds and equities as undervalued. There's no doubt that relative to history, South African bonds are cheap, and relative to history, South African equities are cheap. I think that there's no one's disputing the fact that they are cheap. The fact that unfortunately them being cheap doesn't make them a good investment, because they can get cheaper. So our view in the short term, at least, is they are cheap, but they could get cheaper, and we'll wait to see what happens there. John says, what is the new approach by Japan after they've changed their monetary policy and they now have positive interest rates? I certainly think we're moving into, the next move from Japan is going to be a hike, not a cut. So yes, to as much as the rest of the world is cutting, Japan in the short term at least is hiking. I wouldn't say it's a permanent change, John, but it's definitely, over the next 12 months, they are likely to increase. I think what's more important, and certainly we have gone further underweight Japan, although the returns have been very, very nice out of Japan. What's more important is that as part of that change, they have now stopped buying their ETFs. So they're no longer buying Japanese equities, and they're no longer buying Japanese property. So the buyer of last resort in terms of equities and properties has stopped. So to the extent that we think the yen could strengthen slightly and there's no more buyer of last resort, I think that Japanese equity outperformance is unlikely going forward. But we, as I said, no change to our positioning there. We are underweight Japanese equities. Bruno says Japan is the largest holder of US Treasuries. Is there a risk that domestic Japanese investors sell US Treasuries and buy local Japanese bonds as interest rates rise? And would that see US bonds selling off? Certainly is a risk. Definitely as Japan normalizes their rates, we could see some domestic investors switch out of US into Japan. As I said last month, right now we're seeing Chinese investors switching out of China into Japan. So there's all sorts of movements that happen. It's nothing happens in isolation, but there could be some further selling. Of course, as US bond yields rise and they become more attractive, and as they are seen as the risk off safe haven, I don't think they'll rise too much. And we are neutral global bonds. We remain neutral global bonds. Should have said that earlier. Flavio asked about the outlook for the rand based on South African elections. I did cover that earlier, but in a nutshell, depending on who the ANC partners with is what's going to drive at least the short-term election noise. So if the ANC partners with the DA, well, this could be upside to the rand, below 17. If the ANC partners with the EFF and the MK, well, a lot of weakness, weaker than 21. If the status quo happens and the ANC partners just with some small coalition parties and gets close to 50%, 48 or 47%, well, then probably not much change. There's no more likelihood of reforms happening or of extreme political events happening. So we might see some strengthening of the rand 18, just as the probability of that worst case scenario gets passed. So the bottom line is we do think there could be some rand strength after the elections, because we don't expect either the high road or the low road scenarios to materialize. Louise says, does the Sygnia Enhanced Income Fund have an exposure to my plan IP Enhanced Income Fund, which recently ran into trouble due to taxi debt? Louise, no, the Sygnia Enhanced Income Fund has no exposure to bridge taxi. It's had zero exposure to that instrument. Anesh asks, why has the OSE fund return fallen? Anesh, in the December valuation of OSE, They marked down their net asset value because they marked down one of their large investments, which is the First Light Fusion, and that had a small knock-on effect, negative knock-on effect on the NAV, -4%. However, we are expecting that to improve in the March numbers. We haven't got them yet, but if you look at what's happened in the listed portion of OSE over the last 3 months since the last NAV update, and that is public information. You can see what those listed entities are. They have all risen quite nicely on the back of lots of cash in the healthcare sector, which is chasing biotech stocks. And we do think that there will be a recovery in that NAV when that March NAV comes through. But nothing until that number comes through in the March quarter of OSE. Kubus asks, is there the risk the Sygnia Enhanced Income Fund may be exposed to the same risk as the My Plan Enhanced Income Fund, which was exposed to the tax sector? Kubus, this is a great question. So I think what's very important is what happened with Bridge Taxi. It wasn't just the taxi exposure that was the problem. It was the fact that it was a securitization, which meant that there were a whole lot of tranches. And depending on where you were in that hierarchy, we either lost everything or you lost nothing. Well, in general, when it comes to securitizations, just like when Able went bankrupt, the sub-debt holders lost everything, but senior debt only lost 10%, at a 10% haircut. So it's not just the credit that you're exposed, the issue that you're exposed to. It's not just the industry, which is the taxi industry, but it's the type of debt that you have. So looking at the Sygnia Enhanced Income Fund, we've got about 40 basis points exposure, 0.4%. So compared to the 9% or 9.5% that My Plan had, it's tiny, but it's also to less risky assets within the taxi industry than My Plan had. And although there have been some widening of the spreads of those instruments, they are unlikely to default. And even if they default, you're probably going to get 90% of your money back. So the impact on the fund is going to be absolutely negligible if there is any impact, but it's unlikely due to the diversification we have and the high quality assets that we have and the small exposure that we have in that industry. Alan asks, enhanced income fund versus income maximizer. Okay, so Alan, it's a good question. So the enhanced income fund has almost no exposure to the property sector or the bond sector. At various times, it might be 1 or 2%. Income maximizer is all focused on maximizing the income. So when bonds do have a higher yield than enhanced income, like they do right now, then we add bonds to bond exposure to enhanced income, income maximizer. So income maximizer it's got quite a lot of volatility, not as much as South African bonds, but it is far more risky than enhanced income. So on that spectrum that Anrich showed, we had enhanced income, very defensive, the income maximizer somewhere between enhanced income and bonds, and then we had bonds as the most volatile fund. So you could think of income maximizer as roughly half enhanced income, half SA bonds. John, as a result, the enhanced income fund has limited exposure to foreign sell-off of South African bonds because it only has 1 to 3% of South African bonds. The duration is, as Anrich pointed out, is 0.4. So very small impact to that fund if South African bond yields do rise as foreigners sell. So it is insulated to the bond market to a large extent. Sean says, what proportion of returns come from yield versus capital accumulation for enhanced income? Sean, it should be 100% from yield. So yes, there is some variability of capital as credit spreads rise and credit spreads fall, and the small impacts of capital impacts of the bond and property sector. But as a whole, particularly if you hold the enhanced income for a long time, the income is going to dwarf any capital moves. Obviously, in the short term, there are some capital moves, so the answer will depend on your time period. But if you have to hold them 5 years, it's going to be at least it's going to be 100% income. In the short term, maybe it's 90% income, 10% capital, depending on how short term and to the extent that those capital prices do move. Sean says, what is the fund's Achilles heel? The Achilles heel of the enhanced income fund is the same as money market funds, is that when interest rates start to be cut, so your absolute number does come down. So you saw there that we're getting roughly JIBAR plus 2.6%. JIBAR is very high at the moment. So as interest rates are cut, so that overall return will come down. the JIBAR is only expected to fall between 1/4 and 0.5% over the next 12 months. So it's not a huge impact. But certainly if we do move into a position where in 2 or 3 years' time where interest rates are cut maybe 1%, well then the yield will come down accordingly. Christian points out a great question. He says, we're seeing some warning lights flashing in the US, amber signs on office, amber signs on US consumer. We're also seeing some quite high valuations of the US market. So are we going to see, with only a soft landing, are we going to see a sharp correction, given the US economy must slow down at some point? Could this happen after US elections? Christian, it's a very good question. As I said, we remain overweight US equities for the moment. I do think that as we get closer to US elections, we may need to pare that down to neutral. Generally, returns going into elections are slightly muted. It all depends on who wins, though. So if Biden wins, then we should see strong returns going into the US elections compared to the past, and then strong returns post. But if the Republicans win, then we could see some weak returns going into the elections as the Republicans. That's based on historic numbers. Right now, it could be different because Trump is very much pro US. So I do think there's going to be a lot of volatility that's going to happen in the US. There's also the seasonal factors. So as I said, right now we are overweight US equities, but I think our next move is going to be taking that to neutral, but we haven't done that just yet, but that's definitely what we are watching. So our big key thing is, when do we go neutral on US equities because of all the amber flashing lights and the slowdown that is coming. And we could either move that money to global developed markets, or maybe even global emerging markets, depending on whether the rest of the world growth is accelerating as the US decelerates, or we move that all into developed market bonds if by then the rest of the world is actually rolling over and decelerating while the US is also decelerating. So it all depends. We need to move out of US equities at some point. Do we move it into rest of the world equities, or do we move it into US bonds? And that depends on what's happening in 3 to 6 months' time. EJ says the all bond index, despite the yield, capital loss has been quite high. That's true, certainly, as those yields have risen. So there has been a capital loss, and that has muted the overall return. So if you're a long-term holder, that's fine. You're getting your yield. You could spend the yield, but your capital volatility has shown a loss. And that's been driven by foreigners selling. It's been driven by the extra risk that is coming in terms of the elections, and the fact that our debt to GDP is likely to rise and not roll over. So and it's also driven by the rand. As the rand weakens, so our bond yields go up. The rand strengthens, our bond yields come down. So we could see some capital gains on South African bonds post elections, or if the dollar weakens significantly. So either a weaker dollar or some good news out of South Africa could see the rand strengthen and some good returns out of bonds. Clive says, are you positive on UK equities? Clive, no, we do not have exposure to UK equities. We are quite concerned about, again, elections that are happening there and exactly what that means for the markets and growth. Mervyn, I think I asked your question. SA interest rates probably going to be lowered only 1/4 or 0.5% over the next 12 months. Dave says the 45% invested directly offshore or through local instruments. Dave, the 45% offshore limit is for Regulation 28, so that is for your RAs. We also have for LAs and endowments, there's a Sygnia limit of about 40%, but that's only on those instruments. On direct investments, there's no limit. And so you can invest as much as you want offshore in our ETFs, and if you invest directly. Anonymous asks what my opinion is for Bitcoin growth. Anonymous, I prefer to answer questions where people give their names. It's just easier for me to work out if there are grouped questions. But when it comes to Bitcoin, I can tell you that Alpine Macro think it's going to $100,000. BCA think it's going to $5,000. So choose your strategist. It could go anywhere. Sean says, if SA election delivered a sweet spot, what could the rand strengthen to? Sean, if the ANC partner with the multi-charter party or coalition or the DA, and there's a strong belief that reforms could be accelerated, well, we could easily be below 17 rand to the dollar. Likewise, if commodity prices continue to rally, well, commodity prices rallying is very good for our terms of trade. And if Transnet and Eskom get back on track, well, I think our global local commodity players are already quite immune to Eskom. But if they can get the exports working through Transnet, well, then again, we could see a strong rand. So either a weaker dollar globally as the US starts to cut rates, or strong commodity prices also linked to US cutting rates, or Transnet being fixed, or good election results. All of those could lead to a stronger rand. So there are a number of reasons that we could be positive, but none of them have happened yet, or we'll be watching those quite closely. Anton says, what's the outlook for Sygnia Euro ETF? We are underweight the Euro, but as I said, there are some green shoots coming through in Euro EU region in particular. So maybe some earnings upside surprises. Certainly the City EU Economic Surprise Index is positive, so that's looking good. But right now we still remain overweight US. Victor, if you email admin@sygnia.co.za, they can email you that slide. But otherwise, the presentation will be available on YouTube shortly, so you can review all the slides on YouTube and the Q&A. Sean, we really can't afford another decade of lost growth in South Africa. Let's hope that doesn't happen. But right now, it is more hope than anything else, which is why we remain underweight SA equities, and why I think the Transnational Fund will continue to do well. Elodie, in the long term, you make the most money out of bonds from yields, not capital. Bonds are a nominal asset class. You're only supposed to make money out of yields from bonds over the long term. Yes, there is some volatility, but in your capital, but generally, strategically, you buy a bond for the yield. Pleasure, everybody. Mervyn, last question for the day, asked about my favorite fund, the Sygnia Balanced 70 fund for retirement savings. It's a Regulation 28 fund. And he says, what proportion of the equities are offshore? Mervyn, we're sitting at about 41% offshore for that fund. So, as close to the maximum of 45 as possible. We could go another 1 or 2% higher, but we're pretty close to maximum on that fund. And we do think that's a comfortable place to be until we have more certainty from SA elections, or more certainty on the Fed interest rate regime and outlook. Okay, that is it for all the questions. Thank you, everybody, for joining. It was an absolute pleasure being here today. It was a pleasure to share our views. Thank you for your questions. And I'm looking forward to seeing you all next month for the polls, to hear what you think and to share your views with the listeners. So have a good April, and I'll see you in 1 month's time.